What is up, YouTube? In today's video, I'm going to be talking about stocks I've bought during the stock market correction that occurred in March. The stock market fell around 30% during this time. These were the lowest levels since President Donald Trump was elected. And this was a perfect time to buy stocks, as I didn't know if it was going any lower, so I started averaging down at around 19 or 20,000. So the first stock that I bought, or that I'm going to talk about, is Apple. There are many reasons why I bought Apple stock, and I'm just going to go over some facts. Currently, Apple is a blue chip company as its market cap is around $1.32 trillion. The PE ratio is 22.45, and the dividend is around 1%. And these are one of the few companies that are still continuing to pay dividends, and I wouldn't be surprised if they cut it, but also I wouldn't be surprised if they continue paying it, as they have so much cash. Now, coming to the topic of cash, one of the reasons I bought Apple stock is because of its balance sheet. So currently, Apple has cash and cash equivalents worth up to $100 billion, and the total assets is worth $338 billion. Now, Apple's current debt reaches up to $16 billion, along with some other debt that they may have to repay soon. But debt repayments will be stalled, I believe, and their total liabilities are $240 billion. Now, as we can see, there's a huge difference in assets and liabilities, so it's not a question whether they will last during this tough time where business has been slowed down, but it's a whether question that the demand will still be there. Another reason why I bought Apple stock is because they're a very diversified business, especially during these coming years, like the past 3-4 years. They have really diversified their business. For example, in around 2015 2016 era, they were known for their iPhones, iPads, and maybe Macs, but now they've launched new products such as AirPods. They also bought many other companies like Beats, and they also started their services last year with Apple Music, Apple Arcade, and Apple TV. So even if the sales of products go down, I do think the services will go up. Another thing we have to keep in mind is they're starting to sell cheaper iPhones because most people are getting laid off and they may not be able to afford the new iPhones. As we've seen, they've recently launched a $339 iPhone SE. And even though they pay dividends, they're a growth dividend company. As in 2019, growth definitely still slowed down, but in 2017, the revenue of Apple was $230 billion with earnings of $50 billion. But if we fast forward to 2019, they had earnings of $55 billion along with revenue of $260 billion. So they're still a growing business, and they have a very strong balance sheet, and they're a blue chip, which I think makes it a lot more safe. So this is a safe stock that I don't think will go bankrupt anytime soon. And I also think in the future years we could see huge growth, and I do think that Apple's growth isn't done yet. So now let's talk about our next stock. The second stock that I've bought, or that I want to talk about, is Facebook. Now, my cost base for Facebook during the March 2020 correction is $142, and again, there are various reasons why I bought them. The first reason is they have a really good balance sheet that includes $50 billion in cash and cash equivalents, and they barely have any debt. Another reason is their business model isn't dependent on consumers going to stores, but rather is dependent on people using their appliances like phones, computers, iPads, which many people are doing nowadays because they are at home. So we can see user growth in Facebook during this time, and people use it a lot more often. Even though Facebook's trying to limit this, which I do think they should, because it's not that healthy. Another thing we have to consider is revenue may go down because advertisers are paying less, but over time advertisers will be paying more, which will lead to more revenue due to the growth in ads. And they also have many other apps and subsidiaries that are making a lot of revenue for them, including Instagram, Messenger, and WhatsApp. They still have a monetized WhatsApp, which is another huge opportunity they have. They're also investing a lot internationally, which can also be a huge growth factor in the future. Now, this is a great growth stock, and it's growing at a really fast rate. And I have made a video on Facebook recently, and I'll be putting the link in the description or in the top right corner. Another company that I've recently bought is Tesla. at a cost basis of around $400. This is a company that I've bought for, for a while, and I've also made a video on it. And I have many reasons why I bought this company, and the main reason is because of growth and because of their mission. So Tesla in 2016 generated $7 billion in revenue. In 2017, it generated $11 billion in revenue. And in 2019, it generated $24 billion in revenue. So if you don't know what Tesla does, they have electric vehicles, and that's better for the environment rather than the vehicles that we currently use that run on petrol. And another reason they are a very good company is because they're diversifying their business. Not only are they going into electrical cars, but electrical batteries as well, which they could sell into other car players as well. And they are the biggest electric vehicle player out there with their Model 3, Model Y, and etc. And they're also expanding globally. So recently, if you didn't know, they built a gigafactory in China. They're also looking at other areas to build factories. They aren't in major marketplaces like India, etc. And this could be a great way of growth. And this is the largest cap for a car company, and it's not really valued like a car company but rather a tech company because of its massive innovation in this industry, and it's definitely disrupting it in various ways. And they have a great management team, and even though the balance sheet isn't the greatest, I do think it could be a great stock in the future. But I have seen insane gains over the past month just off the stocks I bought, because I bought it at $400 and it is at $780, I believe. But I still won't sell it because I do believe it has a great future ahead of it. Fourth stock out of the 6 stocks that I bought is Disney. I bought Disney at $92, and there are a couple reasons why I bought this stock. So a couple years ago, Disney was very dependent on just their amusement parks and their movies, and now that the coronavirus shut down, you'd expect them to lose all their revenue, but that's not the case. So in 2018, revenue of Disney stood at $59 billion, but in 2019, it went all the way up to $69 billion. Now, why is this? Well, it's obviously because they had some big releases of their movies in 2019, including the Avengers Endgame, and they had many other movies. But also, they came out with a new service, which was the Disney Plus. And what this did is they had all their past movies and TV shows on this streaming device. And not only that, they also have TV channels called Disney XD, etc. But people started watching less network, and they started going more into streaming, and this allowed Disney to expand their business, which now their service that started a couple months ago has 50 million plus users. And this could be a huge growth. It could drive a huge amount of growth in the future if they continue at this pace, especially if they start their own original series. They're planning to come out with the Loki series and many more. They also came out with Mandalorian, which has been a huge hit. And if they continue, this can drive lots of growth, and one day it may become half as big as Netflix, or even as big as Netflix. And as we know, Netflix is like at a $300 billion market cap, or two. Yeah, so they're also a really big company. So if Disney can replicate what Netflix did, then they would grow a lot more. Obviously, I don't think it would grow at the scale Netflix did for the streaming device, and Netflix is like the pioneer in this industry. But Disney can definitely one day be like 50% of Netflix. Now, this is another blue chip company. Has been there for many years, and they are dividend payers as well. So this is a very safe stock to buy. Now, all 4 of these stocks I have owned previously, and these are very safe stocks, and they're very big. Now, the next 2 stocks that I named, they're more speculative buys that are a lot more risky, but they have been paying off so far. So the 5th stock I want to talk about, which is Gilead, which I've talked about previously. This is a speculative buy, as they're doing major things in curing COVID-19. And recent news came out that they are on a stage 3 of testing, and they may have found the cure, which has made the stock skyrocket. I bought this stock back when it was $70. This is definitely a speculative play, as I do believe they will eventually find a cure, and they're leading in this, and I really hope they find a cure soon. And other than that, I didn't really look at the statistics rather I just looked at what medicine they're using to solve the COVID-19, and Gilead popped up. Now I will be making a video soon on top 5 pharmaceutical companies that you should be watching. Recently they all skyrocketed, and I do think they will grow even more. Now I really do hope we find a cure soon. Stay safe. And the last stock I want to talk about, which is a very speculative buy, is Carnival Corporation. I bought the stock when it was back at $40, and I only bought a couple of shares, but then it went all the way down to $8 and $9 range. So I bought a lot of Carnival Corp at $9.45, which brought down my cost base a ton. So now it's a little around $11. Now, just based on the shares I bought in March, it has grown a lot, and for various reasons. So when the COVID-19 came, many people thought Carnival Corp may go bankrupt, and they cut their dividends from 4% to zero. The stock fell from $50 to $8, and revenue completely, business operation completely shut down. These are one of the businesses that rely on people, going to their actual shop, and they weren't able to last, but rather they got an investment from a Saudi Arabian company that bought an 8% stake, which allowed Carnival Corp to stay afloat. And I do think within the next 2, 3, or 4 years, they can go back to 50 or even 75% operations. And this is only a P ratio that's 5, and it used to be like a 15 or 20 P ratio. And they used to produce $19 billion in revenue with $2 billion in earnings. Now this is only at like $10 billion like market cap stock, which is very cheap. And I do think eventually it'll go up. But I'm also debating whether I should hold this stock in a long-term perspective for the next 5 to 10 years, because cruise lines have many negative effects on the environment, which I do not want to support. So this is definitely a question I will address sooner or later. But as of now, they don't have any harmful effects because they aren't in operations. And I do not think they'll go bankrupt, obviously, because they have issued bonds at 11.5% rate, and they have gotten a investment from a Saudi Arabian company. And also I do not think they'll pay dividends anytime soon because they have to pay off their debt first. So this used to be a very good balance sheet, but now as the COVID-19 came, the balance sheet has really shifted into like a okay or bad balance sheet. Now I want to talk about the future of the stock market. So I stopped buying when it started reaching 21,000, because then there's a huge bull run. Not a bull run, but there's a huge run in the stock market, which made us go from down 30% to only down 15% from our all-time highs, which was the shortest bull market we've ever witnessed. And I'm not gonna buy because companies still haven't reopened, and there's no reason for stocks to go up, and it's only going up based on news, which fluctuates from day to day. So if suddenly there's bad news, I do think the market will dip huge. And also earnings have just started to come out, and it will be interesting to see how big companies like the stocks I've mentioned do in this earnings season. And what you have to keep in mind is Q1 has only been affected maybe the last 2 months or last month of Q1, but for Q2 all 3 months of business will be affected because of the COVID-19, which we could see huge drops, especially in luxury companies that aren't a necessity, like fast food restaurants and chains like McDonald's, like Starbucks, which have reported 50 to 70% drops in some of their stores, which can be huge. And so as of now, I'm keeping cash just in case we see another dip. And also I would be fine if we continue to go up, because I have bought stocks at such low rates. And as of now, I'm just gonna hold whatever I have. I'm not gonna buy it, I'm not gonna sell anything. And yeah, these are just my thoughts. I will be doing a video either tomorrow or day after tomorrow on the 5 pharmaceutical stocks you guys should be looking at. Now they have been making huge developments in solving the COVID-19, and they all have been very positive. And let me just give you a hint. One of those stocks is Abbott Laboratories, and they have made a 15-minute FDA approved test. Now before I get carried away with pharmaceutical stocks, I just want to end the video saying stay safe, stay hygienic, stay at home. And if you enjoyed the video, leave a like and subscribe. Also comment down below what videos you would like to see, and you guys may see it if time permits. And thank you.